I think the important thing here is to balance two opposing thoughts in your head at the same time. The first is volatility is creating opportunity, and there are always opportunities. But the second is, to your point, Scott, this is not the sort of bounce that makes you feel that this episode is over. And actually, I would have preferred a huge open down gap lower today to what we're witnessing right now. So the good news is I think you can make the case for at least a pause here. Definitely a short-term washout has taken place. I'll give you, for instance, XLK, the tech S&P names, hardest hit yesterday. Today they're up the most. Okay, you do want to see that. Right now, 20% of S&P 500 companies have an RSI below 30. So a fifth of the market is statistically oversold. And then you take a look at stocks above their 10-day, almost none. So you're in a situation right now where 90% of stocks are below the 10-day. So there really aren't any names in a short-term uptrend. So you say to yourself, what does that align with? Well, in June, when we bottomed, that's exactly where all those stats were. So you could say, OK, that represented the bottom in the past. That's where money came in. But I think, to your point, you have longer-term issues here. The XLE chart is the worst chart I've ever seen in my life for a sector. Mm-hmm. That looks like it's going to zero right now. Abominable. That's a very important component to the stock market if you're trying to make the case that the recovery, the economic recovery, is going to continue into an 11th year. Charts like those, combined with the weakness in the banks, are telling you, I think, that we're really in danger here. And I agree with what Larry Summers said on the previous program. So
sentiment, Joe, feels like it's wrecked. You know, in the span of a week, you've taken sentiment out back and beaten the daylights out of it. I don't think people know what to make of the market other than what Josh said. It's a more negative tone. And what's going to change that?
I don't think much has changed since last Thursday. And I think, again, going into last Thursday and the tweet, equity investors finally got comfortable fully allocating towards high beta names. And I think that dynamic has changed. And I think Josh is right. I think within the volatility, you're looking for opportunity. I think there is tremendous opportunity, but I want that opportunity to come in the form of a low beta type of equity name. I want the U.S. revenue exposure to be incredibly high, and I want there to be some relationship with the U.S. consumer. I think that's important. We talked a couple of names yesterday, Scott. Chipotle, I still would love to buy it. I talked about the $255 bid for MasterCard. I got that late in the afternoon. I probably would have never pulled the trigger in that tape to buy MasterCard, to your point yesterday, where it's good to be very methodical and almost robotic. So I got filled on my MasterCard. I'm happy about that. You're looking for opportunity. But again, I want low beta versus high beta. And that's the dynamic that's changed in the last 7 days.
You know, Shan, we looked today and, Jason Gewirtz, our former executive producer, pointed out to me, I didn't even realize this, S&P today, exactly a year ago today, we're lower today by a stitch from where we were a year ago today. Now, I know we say over the last 18 months, stocks have done nothing. But 1 year ago, we're lower than where we were a year ago. Where are we going?
It's almost unfathomable given what happened, where we saw the fourth quarter of last year, where we saw the run-up of the first half of this year. But I think what hasn't changed is I think the two things that have been moving the market over that period have been exactly the same. It's been the Fed and China. And I think those of us sitting around this desk, if we had sat here a year ago and said we still would not have a resolution on the China situation, I think that there would have been few of us who would have agreed that we would have been able to have the gains we've had in the first half of the year without that resolution. And so the problem here is that, we have the consumer, to Joe's point, who remains strong. We have retail sales data that's good. We have unemployment data that's good. We have production data that is essentially, continuing to deteriorate.
We're booming,
and will not.
According to Larry Kudlow. He used the word booming.
But the consumer is holding us up. And so if you are in an environment in the back half of the year where you start to see the consumer be concerned about higher prices, where you start to see uncertainty at the corporate level on hiring, those are things that are going to transmit to us potentially moving past this, and being unable to get a boost from a resolution in China would be a huge deterrent to future gains.
Mr. Wonderful, what are we left with here? What are you doing? How do you see things after a week that had a Fed and an escalation of the trade war has now spilled into the currency market, maybe a little more substantially than some thought it might. So where are we? How do you see the market today?
Let's start with the Kudlow comments. He is right. Small, domestic, private companies in America are booming. I'm watching the best quarter in history, which is just over last quarter, which was the best quarter in history. So if anybody's concerned about trade wars affecting the American consumer, it hasn't happened yet. I'm not saying it won't, but so far, unbelievable cash flows from companies in that sort of 500 million to $1 billion, the stuff I invest in. That remains. It tells me no recession in sight in this calendar year. That's my opinion. Now, this...
Do you have investments in small companies of that size that are in the industrial economy or the agricultural economy at all, or not really?
Consumer goods and services, which is the core of the strength in our economy.
And I think to be fair, I mean that you can continue. That's what he's talking about. He said
I'm
consumer.
I'm staying in there. Manufacturing, I see the issues. I see that issue, but I'm telling you, the consumer, which is 2/3 of the economy, is on fire, and I'm loving what I see there. Now, I like the China action. I like what's going on here. I'm in the camp that says, do not stop squeezing their heads, because we're going to get a resolution on two things that'll be the next leg up over the next 2 years. If we can get IP and if we can get access to their markets, just imagine if you woke up tomorrow and there was a deal. What would a guy like me do? I would be hiring lawyers in China to launch 50 products that I have already being manufactured there that I can't sell to their middle class because I get screwed by being ripped off.